I want to start with something that most financial channels will not say out loud because it makes people uncomfortable, and because the comfortable version of this topic gets more clicks. The IRS is not random. The IRS does not audit people by lottery. The IRS does not spin a wheel and pick names out of a hat and send letters to unlucky households who happen to be standing in the wrong place at the wrong time. The IRS uses a sophisticated algorithmically driven scoring system called the discriminant information function. And that system assigns a numerical score to every single tax return filed in the United States. The higher your score, the more your return looks like a return that contains errors, underreporting, or fraud based on patterns the IRS has identified across hundreds of millions of returns over decades of enforcement history. And in 2026, with the IRS having received significant additional funding for enforcement technology and staffing, with artificial intelligence now being deployed to identify return anomalies that human reviewers would have missed, with third-party reporting requirements expanding to cover more transactions than ever before, three specific financial moves that millions of ordinary Americans make every year, moves that feel completely normal, completely legal, and completely routine, are generating audit flags at a rate that should concern every household that has made them. I am going to walk you through all three. I am going to show you exactly why they trigger the system. I am going to show you what the IRS is looking for when they pull those returns for review. And I'm going to give you the specific documentation and reporting practices that protect you from becoming one of the hundreds of thousands of American households that will receive an IRS notice this year because of something they did not realize was painting a target on their return. This is Retire Right America, and this video is not about fear. It is about the specific practical knowledge that separates the households that sail through an audit from the households that spend 18 months in correspondence with the IRS and end up paying penalties and interest on money they genuinely believed they reported correctly. Let me give you a family before I get into the three moves. Their name is the Petersons. David Peterson is 64 years old. He is a retired school administrator from outside Charlotte, North Carolina. His wife Ellen is 61. She works part-time as a bookkeeper for a small family-owned business. The Petersons are not wealthy. They are not hiding income. They are not running a fraudulent scheme. They are a completely ordinary American middle-class household that made three financial moves in the 2024 and 2025 tax years that were perfectly legal, that they reported honestly and in good faith, and that collectively generated an audit flag score high enough to put their return in the review queue. David received an IRS notice in March of 2026 requesting documentation for three items on his 2024 return. The notice was not an accusation. The IRS does not call it an accusation. They call it a correspondence audit or an examination. But the practical reality of receiving that notice, the 18 months of document gathering, the CPA fees, the anxiety, the back and forth correspondence with an agency that communicates on its own timeline and nobody else's. The Peterson family experienced all of it, not because they did anything wrong, but because they did not understand how the three moves they made would look to the algorithmic scoring system that reviews every American tax return. By the end of this video, you will understand exactly what those three moves were, why the system flagged them, and how to make the same moves correctly so that your return does not generate the same score theirs did. The first move that triggers audit flags in 2026 at a dramatically higher rate than most people realize is the home office deduction. Specifically, the home office deduction claimed on Schedule C by self-employed individuals, independent contractors, and retirees who have converted a hobby into a reportable business activity. Let me be precise about what I am saying because the home office deduction is a legitimate legal deduction that millions of Americans are entitled to claim and that they should claim if they qualify. What I am telling you is that the way most people claim it and document it generates a specific pattern that the IRS's discriminant information function scores very aggressively. The home office deduction requires that the space be used regularly and exclusively for business purposes. Not primarily, not mostly, exclusively. The room where you have your business computer but where your grandchildren also sleep when they visit does not qualify. The den where you take business calls but where you also watch television in the evenings does not qualify. The IRS knows from decades of audit experience that the exclusive use requirement is the most frequently misunderstood and most frequently overstated element of home office deductions. They also know that the dollar amount of home office deductions claimed on Schedule C returns correlates very poorly with the business income reported on those same returns in a way that suggests widespread overstatement. The algorithm looks at the ratio of home office deduction to total business income. It looks at the claimed square footage percentage relative to the home's total square footage. It compares your claim deduction to statistical norms for your industry and income level. When your numbers fall outside the normal distribution for comparable returns, the score goes up. And when the score goes up far enough, a human reviewer looks at the return. The protection is documentation, and I want to be very specific about what documentation actually protects you, because vague advice to keep good records is not enough. You need a floor plan or diagram of your home with the business space clearly identified and its dimensions measured and recorded. You need the total square footage of the home from your property tax assessment or your mortgage documents. You need a written description of how the space is used exclusively for business and what the nature of the business activity is. If you use the simplified method, you claim $5 per square foot up to 300 square feet for a maximum deduction of $1,500. If you use the actual expense method, you need 12 months of utility bills, insurance statements, mortgage interest documentation, and property tax receipts, along with a calculation showing the business use percentage applied to each expense. You need to be able to demonstrate with a paper trail that the claimed space meets the exclusive use requirement. The IRS does not have to prove you are lying. In a correspondence audit, they simply ask you to prove you are telling the truth. The families who have the documentation ready send it in, the matter closes, and they get a letter saying no changes are required. The families who claim the deduction based on a rough estimate and a feeling of entitlement spend 6 months trying to reconstruct records that were never created. The second move that is generating audit flags in 2026 at a rate that should alarm every American who has made it is the cash transaction pattern that the Bank Secrecy Act was specifically designed to capture and that has been dramatically expanding in scope due to both regulatory changes and financial institution reporting requirements. I want to be very careful here because there is a specific legal trap embedded in this category that most people have never heard of, and walking into it accidentally while trying to avoid a different problem has ruined the finances of people who were doing nothing illegal whatsoever. The trap is called structuring. Structuring is the act of breaking up financial transactions into smaller amounts, specifically to avoid the $10,000 cash transaction reporting requirement that financial institutions must follow under the Bank Secrecy Act. When you deposit or withdraw $10,000 or more in cash in a single transaction, your bank is required by federal law to file a currency transaction report with the Financial Crimes Enforcement Network. Most people know this. What most people do not know is that deliberately making multiple transactions below $10,000 to avoid triggering the CTR is itself a federal crime, regardless of whether the underlying money is from a legitimate source. You do not have to be a drug dealer or a money launderer to be prosecuted for structuring. You just have to make a pattern of transactions that the bank's compliance software identifies as deliberate avoidance of the reporting threshold. The IRS and FinCEN share data. Structuring patterns identified in bank records are cross-referenced against tax returns. If the pattern of transactions does not align with the income reported on the return, or if the pattern itself suggests deliberate threshold avoidance, the return gets flagged. David Peterson, our retired school administrator from Charlotte, sold some furniture and personal property in 2024 and received cash payments totaling about $38,000 over several months from different buyers through a combination of Facebook Marketplace and Craigslist transactions. David deposited these proceeds in amounts of $7,000 to $9,000 each time because he had heard somewhere that deposits over $10,000 attracted attention, and he wanted to avoid that attention. David was not reporting criminal income. He was reporting legitimate proceeds from the sale of personal property, most of which was not taxable because he sold it for less than he paid for it years ago. But the pattern of deposits, each one carefully sized to stay below the CTR threshold, was identified by his bank's compliance software as a potential structuring pattern. That pattern was reported to FinCEN. FinCEN cross-referenced it against David's tax return. The combination of the structuring pattern and some questions about how he reported the proceeds generated an audit flag that contributed to the correspondence audit notice he received in March. David did nothing illegal in the substantive sense, but by trying to stay below the reporting threshold, he actually created a reportable pattern that was more suspicious than a single large deposit would have been. The correct approach, which David did not know about because nobody told him, is to deposit the full amounts without breaking them up, to keep clear records of every sale transaction, including the item sold, the sale price, the original purchase price, and the buyer's information where available, and to report the transactions correctly on Schedule D, or as non-taxable personal property sales as appropriate. A single $10,000 deposit triggers a currency transaction report. It does not trigger an audit. A pattern of $9,800 deposits triggers a structuring investigation. The transparency is always safer than the workaround. The third move that is generating audit flags in 2026 involves something that has caught an enormous number of retirees and near retirees completely off guard because the rules changed and the notification was buried in a Form 1099 instruction update that almost nobody read. I am talking about the reporting requirements for digital asset transactions and peer-to-peer payment platforms, and specifically, the expanded third-party reporting requirements that went into effect for transactions processed through platforms like Venmo, PayPal, Cash App, and Zelle when used for business or investment purposes. Starting with transactions above a very low threshold, these platforms are now required to issue Form 1099-K to recipients who receive payments for goods and services above the applicable reporting threshold. The threshold has been changing, and the IRS has been phasing in the requirements over multiple years, but the direction of travel is clear, and the reporting net is expanding. What this means practically is that if you receive payments through any of these platforms for goods sold, services provided, rental income, or any other business or investment activity, and you did not report those payments on your tax return because you did not receive a 1099 in prior years and assumed the income was not reportable, you now have a mismatch between what the platform reported to the IRS and what appeared on your return. The IRS's automated matching system, which cross-references third-party reported income against return line items, identifies these mismatches automatically. A mismatch between a 1099-K issued by a payment platform and income reported on your return generates a notice automatically, without any human review being required. The notice comes first. The audit follow-up comes if you do not respond adequately to the notice. Ellen Peterson, David's wife, received approximately $14,000 through Venmo over the course of 2024 for bookkeeping work she did on a freelance basis for several small businesses, in addition to a regular part-time employer. Ellen reported her regular employment income correctly. She did not report the Venmo payments because she did not receive a 1099 from any of the individual businesses she worked for, and she assumed that the informal payments were not tracked. Venmo issued a 1099-K to Ellen for the $14,000. When the IRS matched that against her return, the $14,000 of unreported self-employment income generated a notice that was part of the same correspondence audit package that David received for his other issues. Ellen owed self-employment tax on the $14,000 in addition to the income tax, because self-employment income is subject to the 15.3% self-employment tax on top of regular income tax. The combined tax, penalty, and interest liability on that single unreported income item was substantial. Not because Ellen was dishonest, because she did not know the rules had changed and that the payment platform was now reporting to the IRS on her behalf. The protection is simple, but requires a change in how you think about payment platform receipts. Every dollar received through a digital payment platform for any business, freelance, or investment activity is taxable income, regardless of whether you receive a 1099. The 1099 is a reporting document, not a permission slip. The income was always taxable. The new reporting rules simply mean the IRS now knows about it independently of your return. Going forward, keep a running log of every payment received through these platforms for business or investment purposes. Categorize it by income type, track your deductible business expenses related to that income, and report the net self-employment income on Schedule C with the full gross receipts matching or exceeding whatever the platform ultimately reports on the 1099-K. If you have prior year unreported digital payment income, the voluntary disclosure path through a corrected or amended return is significantly less costly than the audit path, where the IRS finds it first. A CPA who works with self-employed individuals or freelancers can help you assess the prior year exposure and the best path forward. I want to bring the Peterson family back for a final observation because their story contains something important that goes beyond the three specific audit triggers I described. David and Ellen Peterson are intelligent, honest, responsible people who made three financial moves that were either legal, partially legal, or accidentally non-compliant through ignorance of changed rules. None of the three moves involved intentional fraud. None of them involved hiding criminal proceeds. All three of them generated audit scrutiny because of how the moves were made and documented, not because of what the moves were. The IRS's algorithmic scoring system does not make moral judgments. It does not distinguish between the person who is trying to cheat and the person who is trying to comply but made a documentation or reporting error. The score is calculated on patterns and ratios and matching discrepancies. The audit that results from a high score treats both types of cases with equal procedural formality. The family that was genuinely trying to comply but documented poorly ends up spending the same amount of time and CPA fees as the family that was cutting corners. The protection is not just honest intent. The protection is honest intent combined with documentation practices and reporting habits that make the return look, to an algorithm that cannot read minds, exactly as clean and correctly reported as it actually is. Here at Retire Right America, we cover topics like this because the financial threats to retirement security in 2026 are not limited to market volatility and tax bracket changes. A single IRS correspondence audit, even one that ultimately results in no additional tax owed, can cost a retiree family between $3,000 and $15,000 in CPA fees and time, create months of administrative burden during what should be the most peaceful years of their lives, and in cases where unreported income is discovered, generate tax assessments with penalties and interest that permanently reduce the retirement resources that were supposed to last 30 years. Go to the comments section right now and tell me if you have made any of these 3 moves in the last 3 tax years. Tell me if you have claimed a home office deduction and whether you have the documentation I described. Tell me if you have received payments through digital platforms for any business activity and whether those payments were reported. Tell me if you have made any cash transaction patterns that might look like structuring to a bank compliance system. I am not asking so I can judge you. I am asking because the comment section of this channel is where we identify exposure before the IRS does, and the families who find out about a problem here have options that the families who find out through an IRS notice no longer have. Drop your situation in the comments. We work through it together. Like this video if it showed you something about your own financial activity that you had not thought about from the IRS's perspective before. Subscribe to Retire Right America and hit the notification bell because the tax enforcement landscape in 2026 is changing faster than most households realize, and every video on this channel is designed to keep you one step ahead of the mechanisms that are moving against you. Share this with someone who made any of these 3 moves in the last 2 years and has not thought about whether their documentation and reporting are strong enough to survive a correspondence audit. This is Retire Right America. Stay informed, stay documented, and stay protected.